Japan built the world's third largest economy. Today, its debt towers at over 260% of GDP, and entire towns are vanishing as the population ages. Beneath Tokyo's shining skyline, the foundation is fracturing. This is not just a slowdown, it's the beginning of a collapse with global consequences. The question isn't whether Japan's economy is in danger, it's how close we really are to the tipping point. Japan's national debt now stands at nearly $12 trillion, an amount that exceeds the entire economic output of the country by more than 2.5 times. According to the Ministry of Finance and IMF data, the debt-to-GDP ratio is approaching 260%, the highest among advanced economies and more than double the level seen in the United States or the United Kingdom. In the G7, no other country comes close. Germany's debt hovers around 65% of GDP. France, Italy, and Canada range between 100 and 150%. Even Greece, once a symbol of sovereign debt crisis, now carries a smaller burden relative to its economy than Japan. This is not a short-term spike or a temporary response to crisis. Japan's debt mountain has been growing for decades, fueled by years of government borrowing and relentless fiscal deficits. What was once a manageable burden has become an enormous liability, dwarfing the country's annual tax revenues and outpacing its economic growth year after year. The sheer scale is staggering. For every yen generated in the Japanese economy, more than 2.5 yen are already owed. To put this in perspective, if every Japanese citizen, young and old, were to split the debt equally, each person would owe the equivalent of nearly $95,000. The country's debt per capita is among the highest in the world. The numbers are so large, they almost lose meaning, yet they define the economic reality facing policymakers in Tokyo. Japan's government now spends more on interest payments and debt servicing than it does on public education. Each year, a growing share of the national budget is locked away just to keep the system afloat. Behind these headline figures lies a question. How did the world's third largest economy allow its debt to reach such heights? The answer lies not just in numbers, but in the choices and pressures that have shaped Japan's fiscal path for a generation. After the collapse of Japan's asset bubble in the early 1990s, a new pattern of fiscal behavior took hold. Policymakers, facing a stagnant economy and a fragile banking sector, leaned heavily on government borrowing to fill the gap left by weak private investment. Takeo Hoshi, a leading authority on Japan's financial system, describes how the country's banks, once flush with household savings, became deeply intertwined with government debt. As corporate lending dried up, banks shifted their portfolios toward Japanese government bonds, creating a tight link between state finances and the financial sector. Political leaders found that borrowing was not only possible, but increasingly painless. With interest rates held below 1% for most of the past 3 decades, the cost of servicing new debt barely registered on the national balance sheet. Chronic primary deficits, where government spending persistently outstripped tax revenue, became routine. Each year, the Ministry of Finance issued new bonds to cover shortfalls, confident that domestic banks and institutional investors would absorb the supply. Andrew Gordon, a historian of modern Japan, traces the roots of this fiscal approach back to the post-war era. The habits of consensus-driven politics and a reluctance to challenge entrenched interests made it difficult to rein in spending or raise taxes, even as the population aged and economic growth slowed. Efforts at structural reform repeatedly stalled, leaving the government reliant on stimulus packages and public works to prop up demand. The result was a slow but steady normalization of deficit spending, with little political cost and few immediate consequences. Over time, the boundary between fiscal and monetary policy blurred. The Bank of Japan's interventions, first to stabilize markets, then to suppress borrowing costs, further encouraged the government's reliance on debt. By the early 2000s, the pattern was set: low rates, easy borrowing, and a growing dependence on the banking sector to finance public obligations. This quiet realignment of incentives laid the groundwork for the debt mountain now looming over Japan's future. Japan's demographic transformation is unfolding at a speed and scale without modern precedent. According to the National Institute of Population and Social Security Research, people aged 65 or older now make up 30.2% of the population, nearly 1 in every 3 citizens. Projections point even higher. By the mid-2040s, that share will surpass 33%, setting a new global record for population aging. The fertility rate, meanwhile, has fallen below 1.4 births per woman, far beneath the 2.1 needed to sustain the population. These numbers are not abstract. They define the country's future workforce, tax base, and even the viability of entire communities. Demographer Nicholas Eberstadt describes Japan's trajectory as a gray tsunami, a relentless wave of aging that is shrinking the population at both ends. As the base of the population pyramid narrows, the number of working-age adults supporting each retiree is collapsing. In 1990, there were more than 5 people of working age for every person over 65. Today, that ratio has fallen to just 2. By 2050, it is expected to drop below 1.5. This shift is not just a matter of statistics. It is a structural transformation that is reshaping every aspect of Japanese society and its economy. Population forecasts from the IPSS show an unbroken line of decline. Japan's total population peaked at 128 million in 2008 and has since fallen by nearly 3 million. If current trends continue, the country will lose another 16 million residents by 2050, an exodus larger than the population of Tokyo itself. The consequences are already visible in labor shortages, empty classrooms, and a social security system under unprecedented strain. For policymakers, these numbers are more than warnings. They are the hard limits of what can be sustained in a rapidly aging nation. Yubari, once a thriving mining city in Hokkaido, now stands as a warning for the rest of Japan. After its coal mines closed in the late 1980s, the city's population plummeted from over 100,000 to just a few thousand. As tax revenues dried up, city officials tried to fill the gap with ambitious public works, theme parks, hotels, and tourist attractions, all funded by heavy borrowing. By the time Yubari declared effective bankruptcy in 2007, it owed 35 billion yen, nearly 9 times its annual budget of just 4 billion yen. The city was placed under strict fiscal rehabilitation, forced to sell off assets and slash public services. Schools closed, clinics shut their doors, and the elderly, now the overwhelming majority, were left with little support. A former mayor described the feeling as managing decline, not growth. The story repeats itself across Japan's shrinking towns. In Nagoro, Tokushima, the living are outnumbered by handmade dolls that fill abandoned homes and classrooms, each one standing in for a departed neighbor. With almost no working-age residents left, the village depends on government transfers just to maintain basic services. In Akita, a nurse in her 50s describes caring for more patients each year, as younger families leave and the population ages in place. Local taxes can't keep up with the rising costs of elder care, and community safety nets are stretched to the breaking point. These stories reveal the ground-level reality behind the numbers: empty main streets, shuttered shops, and a sense of abandonment that no amount of central funding can fix. What happens to Yubari, Nagoro, and Akita is not isolated. Each local failure adds new pressure on the national budget, as the central government is forced to step in with bailouts or increased transfers. The collapse of these towns is not just a local tragedy. It is a signal of the fiscal and social strains threatening Japan as a whole. The yen has lost more than 20% of its value against the US dollar since 2022, a slide that has shaken confidence across global currency markets. For decades, the yen was seen as a safe haven, stable, predictable, a pillar of the international financial system. That reputation is now under threat. In Tokyo's trading rooms, screens flash with red as volatility surges to levels unseen since the 1990s. The Bank of Japan's efforts to steady the currency by keeping interest rates near zero while the US Federal Reserve hikes aggressively have only deepened the pressure. As the yen weakens, import costs for energy and food soar, squeezing households and businesses already facing stagnant wages. A senior foreign exchange trader describes the mood as tense and uncertain. There's no anchor anymore. Every day feels like uncharted territory. This isn't just a story of numbers on a screen. The yen's decline is a warning sign, a signal that the world's third largest economy is losing the trust of investors who once saw it as a fortress. The multi-year chart tells the story in stark terms. A downward slope punctuated by brief, frantic rallies, then new lows. Implied volatility, a measure of market stress, has doubled since 2021. Speculators circle, betting that the Bank of Japan's resolve will falter. What was once unthinkable, a sudden uncontrolled drop in the currency, now dominates conversations in financial centers from London to New York. The first cracks have appeared, and the consequences are rippling far beyond Tokyo. On July 29, 2025, the Bank of Japan intervened in the government bond market 3 separate times in a single day. Morning and afternoon securities lending operations flooded the repo market with bonds, a move designed to relieve acute shortages as overnight rates spiked. Later, the central bank tapped its dollar swap line, injecting foreign currency liquidity amid signs that stress in the Japanese government bond market was spilling into cross-border funding. These actions were not routine maintenance. They signaled a system under severe strain. The bank now holds more than half of all outstanding Japanese government bonds. This concentration has hollowed out the market, leaving private investors on the sidelines and draining liquidity from key maturities. When the bank steps back, even briefly, the result is a desert. Trading dries up and repo markets seize as dealers scramble to source specific bonds for settlement. On July 29th, despite 3 rounds of intervention, yields on 30-year Japanese government bonds continued to rise. The market no longer responds predictably to the central bank's toolkit. Governor Ueda addressed these tensions directly, stating, "Interest rates should be formed in the markets." Yet the bank's overwhelming presence means genuine price discovery has all but vanished. The holder composition chart tells the story. Over 50% of Japanese government bonds sit on the Bank of Japan's balance sheet, with domestic banks and insurers accounting for most of the rest. Foreign investors, once seen as marginal, withdrew 2 trillion yen in a single week this September, the largest exodus in a year. For years, officials argued that Japan's debt was safe because it was held domestically. But a market that depends on constant central bank support is not immune to dysfunction. When repo rates spike and multiple interventions fail to calm volatility, the structural fragility of the system becomes impossible to ignore. Japanese investors have long played a central role in global finance, quietly shaping the cost of borrowing far beyond their own borders. For decades, Japan was the largest foreign holder of U.S. Treasury bonds, providing a steady anchor for American borrowing costs, even as Washington's deficits ballooned. In 2024, Japanese institutions held more than $1.1 trillion in treasuries, second only to China at the time. But as domestic pressures mount and the yen weakens, this tide is turning. In the first half of 2025, Japanese investors cut their holdings of U.S. government debt by over $120 billion, the sharpest annual decline in more than a decade. The consequences ripple outward. As Japan retreats, the U.S. Treasury faces a thinner pool of buyers, pushing yields higher and raising the cost of government borrowing. This dynamic is not confined to treasuries. Japanese banks and insurers have also begun scaling back on European and emerging market bonds, triggering a measurable uptick in global rates. Financial historians point to past episodes, such as the 1998 Asian financial crisis, when sudden shifts in Japanese capital flows amplified market stress worldwide. Carmen Reinhart, a leading authority on sovereign debt contagion, describes these spillovers as a bond channel, a mechanism through which trouble in one country's debt market can transmit shocks to others, even those with seemingly little direct exposure. the recent volatility in JGBs has heightened investor anxiety, with analysts warning that a disorderly sell-off could force Japanese institutions to liquidate more foreign assets to cover losses at home. In this scenario, the world's largest cross-border bond investors become a source of instability, not stability. Reinhardt warns, when the anchor moves, the whole fleet shifts. The fate of US and global yields is now tied more than ever to the turbulence inside Japan's financial system. Factories in Taiwan, South Korea, and California depend on a steady flow of Japanese materials to keep their production lines running. In the world of semiconductors, there is no easy substitute. Japan supplies nearly 90% of high-end photoresist, a chemical essential for printing microscopic circuits onto silicon wafers. Without it, advanced chip-making grinds to a halt. Companies like JSR, Tokyo Oka Kogyo, and Shinetsu are the backbone of this trade, shipping out barrels of photoresist that underpin the world's most advanced electronics. Fluorinated polyamide, another specialty, is used in flexible displays and next-generation packaging. Japanese firms control about 70 to 80% of global supply. When export restrictions flared between Japan and South Korea in 2019, Korean chip giants scrambled to secure enough stock, sending shockwaves through the global electronics market. The lesson was clear. A disruption in Japan's chemical plants could ripple through every major tech supply chain, from smartphones to electric vehicles. A senior executive at a semiconductor equipment firm describes the risk in blunt terms. If a typhoon shuts down a single Japanese factory, production targets in 5 countries can be missed within days. There's no backup. The purity requirements are so extreme that even the best attempts to diversify have fallen short. Japan also dominates in high-purity silicon wafers, hydrogen fluoride, and advanced developers, each with market shares above 50%. For many of these inputs, alternative suppliers exist only on paper. US and European firms have tried to catch up, but their market share in advanced grades rarely exceeds 10 to 15%. Industry analysts warn that even a modest supply shock could trigger price spikes and cascading delays worldwide. The world's faith in just-in-time manufacturing rests in part on the quiet reliability of Japanese industry. If that reliability falters, the impact would be felt not only in the stock prices of tech giants, but in the shelves of electronics stores and the delivery timelines of automakers. The financial risk is no longer confined to balance sheets. It now runs straight through the heart of the global economy. Japan's debt now stands at more than $12 trillion, over 260% of its GDP, an unprecedented figure among advanced economies, confirmed by the Ministry of Finance and IMF data. Decades of low interest rates, persistent deficits, and a rapidly aging population have brought fiscal and social strains into sharp focus. As the number of citizens over 65 surpasses 30% and workforce numbers decline, towns like Yubari reveal the human cost of municipal collapse. The yen's 20% drop since 2022 and the Bank of Japan's ownership of over half of all Japanese government bonds show mounting market stress. Despite extensive documentation of these risks, the full impact on global markets, especially US treasuries and vital technology supply chains, remains uncertain. Experts agree on the scale of Japan's vulnerabilities, but debate the timing and reach of potential contagion. If one of the world's most stable economies can face such cracks, the question is not if, but where the next shock will surface.